Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. If you look around the overall markets right now, you would think everything is expensive and there is no opportunities for long-term investors right now. And that's not always the case. We've seen it over the last 4 or 5 years where stock market has hit all-time highs in 2021. Every single week we were hitting new all-time highs, just like we are right now in the S&P 500, the Dow Jones, the Nasdaq. All three of them sort of are team tagging, if you like, doing everything they can to stay top. And there's not a lot of sentiment like other than AI, and everyone's calling it bubble and all of these things happening right now. And we've seen this before. We've seen opportunities come and go because we were too scared of buying stocks. We're too scared of buying generally because everyone thinks everything is expensive. And that's not always the case. There are some companies that are genuinely very high quality businesses and doing well, have been doing well, will continue to do well, that are sort of left behind when it comes to this bull market that we are on right now. And what I like to do, I've done all over the last whatever years, is just to look at companies that are undervalued at this point in time and share it with the community. Again, this doesn't mean you should go away and buy any of the companies that I'm going to suggest today, but you should always do your research and make sure you understand the business and the fundamentals behind the business. And if you are comfortable holding that company, even if it goes down 20%, 30%, 40%, because you understand the business, because you know in the long run you will make money, inshallah, in the long run, then of course go ahead and buy it. And what you see right now is the S&P 500, and as you can see here, this is 14%. So right now, if the market closes at the end of this, basically today, for example, like to be up 14%, if you told people, at the time where in April, where the stock market was down, what was it, the S&P 500 was down 15% at some point, at that point, most people would have told you absolutely crazy. But look, since then, we've been going up every single week. And now we're in all-time highs, if you like. So what I'm going to do now is share with you guys these 5 companies that are still undervalued. If you haven't liked the video, please do so. It makes you really genuinely a huge difference to the channel. If you haven't joined us at the Patreon account, feel free to do that. But let's get started. And just before I start, just to share with you guys where we are now with the portfolio itself, we are closer to £130,000, and as you can see here, just for this week we were up about over £3,000. Next week we could be down 10%. 10%. This market is absolutely crazy. I wouldn't be surprised if that happens. But yeah, things have been okay so far. Let's see how things go in the long run. Let's go back here and let's have a look at these 5 companies I would like to share with you guys. First one I want to share with you guys is the one that I spoke about recently. That's S&P and Global. And this is what I mean by when I say, this is a high quality business in my opinion, and it's financial sector or data and data analytics. They provide credit ratings, they provide financial data, market intelligence, indices like the S&P 500 and so on. They've got absolutely wide moat when it comes to the moat side of things, because they play a essential role in global finance. For example, government, investors and corporate rely on its ratings and things like that for the benchmark and stuff. Growth side of things, we are basically the increasing demand for data analytics and sustainable financial insights helps this company grow every single year. And yeah, they've got strong recurring revenue. Basically, they also have a high margins, and I'll show you exactly that in a second. The market cap right now is $148 billion. As you can see, they do pay dividends, and it's 99% safe. It's very small, so this is not a company you will buy right now to sort of make a lot of money on dividend side of things. This is a dividend growth company. I'll just explain that in a second. You can see the payout ratio, 23%. 51 years of increasing that dividend is absolutely crazy. The latest increase was 5.5, and the last 5 years they basically grew that dividend over almost closer to 10%. And as you can see, that 51 years of increasing that dividend, that makes this company a dividend aristocrat. This is what you get for every share of the company that you own. And when we look at the rest of the financials, earnings per share is increasing every single year. Free cash flow per share is increasing. Shares outstanding, it was basically going down, decreasing every single year. But 2022, because they acquired another business, they have actually diluted it a little bit. Since then, they have been buying back, which is quite nice. And this is the revenue side of things, from $5.3 billion to right now $14.7 billion of revenue, which is really good. Return on equity 11%, return on invested capital of 9%. Operating margins, probably one of the best out there. Like I said, is high operating margins, 41%. Free cash flow margins of 37%. And when it comes to debt levels, very, very low. Now going back here, according to Morningstar valuation, you can see $570 per share is where they think the price should be. Right now it's 470, let's call it 480, and that's about 19% upside from where we are. If we check out Wall Street and what they think of this company, as you can see here, Wall Street thinks a strong buy, 18 strong buys, 6 buys, 1 hold, so no sales whatsoever. 28%, 29% upside from where we are. $617 per share is where they think the price should be. And moving forward, expectation wise, in terms of growth, you can see here 20, that's the data that we use in here. Okay, sorry, if we go back here, oops, sorry, here we go. If that 12%, 7% basically comes from here. So this is 2026, so this is December of next year, so we're not using this year, that's by the end of this year. So 2020 basically 6, 2027 more or less 12% growth in terms of EPS, in terms of revenue about 7-8% moving forward. So really great company, but it seems undervalued at this point in time. So if you're interested, just go away and do a little bit more research to find out about a lot more about the company. The next one is Qualcomm. Qualcomm is one of those companies that have been, under my radar for last few weeks. I've sold it a while ago because I've owned so many semiconductor companies. I just wanted to take some profit and also trim it a little bit. And I trimmed it to the point where I actually got rid of it finally, because I've got Nvidia now, which is growing in the portfolio, and I don't like having too much dissimilar sort of a similar companies in the portfolio, not dissimilar. So it's semiconductor company, designs chips and wireless technology like the Snapdragon processors, the 5G modems, basically that's used in smartphones, cars, and the Internet of Things. They are a leader when it comes to 5G technology, and the earnings margins, high margins of royalties from patent that the company has. So a lot of other companies use basically designs this company has, which means they have to pay. So they have to pay some sort of a patent, and they're expanding beyond mobile, mobile phones into automotive, for example, AI, edge computing, and Internet of Things like that. So they are very good in terms of when it comes to cash generating, basically helping shareholder, by paying dividends and buying back their own shares on side of things. So really good company overall. They have a market cap of $182 billion. Dividend is very safe, over 2%, which is quite nice to see. Credit rating A rating, which is strong. Payout ratio very small. Latest increase about 5%. The 5-year growth rate of 6%. 21 years of increase in this dividend. So 24 more years will become dividend aristocrat. $3.56 is what you get for every share of that company that you own. In terms of earnings per share, as you can see, it's been going up and then it's jumped, and again it slightly came back down again, and then it's going up again. If you free cash flow, same sort of a situation. Shares outstanding is declining, which is nice to see. When it comes to total sales or revenue side of it, this is very cyclical business. So some years they do really well, some years they slightly decline. Return on equity 45%, which is probably one of the best out there. Return on invested capital of 23%. Again, really good. Operating margin 28%, free cash flow 27%. So this is very well run business overall, and they don't really have much of a debt, which is quite nice to see. Now just looking at what Wall Street thinks, 11 strong buys, 5 buys, 19 holds, and 1 strong sell. Overall, that is about 5% upside from where we are, $178 per share. Earnings expectation is not the best moving forward, about 2%. So when it comes to revenue, it's not great. Again, this is very cyclical business. There was a time where I owned the company, and the shares of this company, they were basically had a negative earnings expectations, but within a year or so that changed very quickly from that to almost a 10-15% of in terms of a growth side of things. So things can very much change when it comes to semis. They're very cyclical businesses. The next one is MSCI, and this is again very similar to S&P Global. It's a financial sector side of things, indexes, analysis, develops and maintains financial indexes like, for example, the MSCI World, ESG ratings, and so on. When it comes to risk and analytics tools that they have, basically are used by loads of managers around the world. But yeah, so great company, very similar to S&P Global. And it has a very highly scalable business with over 90% recurring revenue, which is one of the reasons I actually like the company. $572 per share, $70 per share is where they think the price should be. It's $560 right now. That's about 2% upside from where we are. Now looking at the market cap side of things, 43%, 61% when it comes to that dividend safety. 1.3 is what you get. In terms of rating, triple B minus, we've got 42% when it comes to payout ratio. Dividend growth is probably one of the best out there, almost to 13% when it comes to the latest increase, 21% when it comes to the last 5 years, 10 years of increase in that. $7.20 is what you get for every share of this company that you own. Earnings per share looks absolutely beautiful. The charts are really great when it comes to free cash flow per share and earnings per share. If you look at shares outstanding, is declining, total shares is heading the right direction. Return on equity, because they have a negative, they've got more current liabilities than current assets. That's why they have a negative return on equity. Return on invested capital 33%, which is really great. Operating margin, one of the best out there, 54%. Free cash flow margin of 46%, and debt levels is very small. So really, really good company overall. And then when you look at the Wall Street expectations, okay, so 9 strong buys, 5 buys, 4 holds, and 1 sell if you like. And overall, that's about 11% upside from where we are, $623 per share. Earnings expectations moving forward for the next couple of years. So this is this year. So the next year, 12%, again, another 12%, 11%, and so on when it comes to EPS. When it comes to revenue, about that 9%. So overall, really great company, and it is another one that is undervalued. So when we use basically the Morningstar valuation, we normally add about 10%. And the reason we add that 10% is just to kind of give you a margin of safety. So I would definitely not buy these companies straight away. I would probably wait for them to drop, okay, unless you're buying S&P Global. Okay, again, I'm not giving you financial advice, but that's probably the one I would actually buy right now without hesitation. But the others, I would actually wait. The next one is Coport. This is automotive and online auction company. It operates online auctions platforms for basically used cars and so on. They've got businesses now in the UK, in Germany, the US, UAE, and so on. So they kind of globally diversifying their business, but they are the market leader when it comes to sort of a car auctions online thing. And I love the fact that they're very asset light model with high returns on capital and steady growth. So basically I'll show you in a second, in fact, that what that does to the margins of this business. And as you can see here, $57 per share is where they think the price should be, 26% upside from where we are. This company doesn't pay any dividends, but almost a 44 billion market cap. When it comes to earnings per share, it looks absolutely beautiful. Free cash flow per share looks good. Shares outstanding has not declined. Slightly increased in 2025, but that's not bad at all. Nothing huge there. Total sales or revenue side of it looks absolutely amazing. Return on equity is slightly declining, which I don't like, but it's about 18%, which is still good. Return on invested capital about 15%. Operating margins of 38%, and free cash flow margin of 27%. Debt levels are almost non-existent with this company. So really, overall, so far so good. Let's go to the ratings of this business. Have a look at what Wall Street is saying. 3 strong buys, 3 buys, 5 holds, so no sales whatsoever. 25% upside from where we are. 56% is where they think. $56 per share is where they think. This one is 57, that one is 50, so not much of a difference. So that's 25% upside from where we are right now. If we look at the earnings expectations moving forward, it's not great. So about 11%, 15%, again 7%, 8% when it comes to revenue. But in 2028, they're expecting the earnings to grow revenue to grow about 20%, which is quite nice to see. And the final company we're going to talk about today is one that a lot of you have been asking me recently, but you've got a lot of comments on the Patreon account. If you haven't joined us on Patreon, please do so, where a lot of brothers have been asking me to have a look at this company because it seems undervalued at this point in time. And according to Morningstar valuation, it is undervalued about 15% right now. Current price is $912 per share. They're expecting just over $1,000 per share. Now, this is probably one of the best companies out there. If you haven't come across software cloud side of things, that's what they do. They provide cloud-based workflow, automation software for enterprise or IT, HR, and operations and so on. They basically help large organizations digitize and automate their processes, reducing costs and improving productivity. In terms of growth side of it, strong adoption of AI-driven automation and platform expansion across industries, and consistent double-digit revenue growth and high renewal basically rates, as well as scalable software as a sort of a SaaS model, if you like. So they're very similar to Salesforce, and they are in the right industry right now where a lot of companies are moving away from trying to basically automate a lot of their processes, and this is the best company when it comes to that side of things. So let's have a look at a little bit more information about the company. So almost 190 billion market cap, so credit rating is about A. When we look at the earnings per share, heading the right direction. Free cash flow per share, absolutely amazing. Shares outstanding has been declining, and then, well, it's been going up and then sort of now started to decline. Wait, it was declining, then it's gone up a couple of the last couple of years. Now, I don't blame for this kind of type of business to actually dilute the shares, because instead of going to the bank to borrow some money for high interest rate, it's better to actually the company do that, because they need to grow it. So if they want to put more money into AI, for example, I'd rather them use their shares rather than actually buying back, rather than going to the bank and so on. So total sales we're looking at basically from 1 billion to right now 12 billion in the last 10 years, which is huge. Return on equity 17%, return on invested capital we're looking at about 10%. Again, the company is still on the growth side of things, but operating margins of 14%, free cash flow margin of 32%, and debt levels are very almost non-existent. If we look at what Wall Street thinks of this company right now, they're saying it's strong buy, 32 strong buys, 8 buys, 4 holds, and 1 strong sell. Now, that means about 26% upside from where we are. $1,147 per share is where they think the price should be. If we look at their estimates moving forward, because remember, all of these things come from, so the ratings in this stuff, you would basically hope that is based on the expected earnings of the company, the free cash flows, the earnings per share, and all of these things. And this company is probably one of the best out there when it comes to that. Look at those double-digit growth every single year for the next couple of years. When it comes to EPS side of things, revenue is exactly the same. So this is a very high quality business in my opinion, but right now one that's still undervalued. Even if you take that into consideration, that 15% and you want a 10% margin of safety, you still got that. So, which is really good. I really like the business. It's a great company, very similar to Salesforce. Do I want to own both of them? Not too sure. So this is what I'm still doing a little bit more digging, and hopefully in the next few weeks I'll let you know exactly what I'm doing with this one. But yeah, that's the 5 companies I wanted to share with you guys today. There's a lot of opportunities out there, so don't listen to the noise and just stop investing. You also, in your portfolios, there might be some companies that are still undervalued. I do own quite a few companies that are still undervalued, and I'll show you in a second. You know, a few months ago, we were talking about basically Hershey. I was buying Hershey almost on regular basis. My average is $183 per share. It's gone up now, 190 something. But I'm down a lot because of the FX impact. But the point I'm trying to make here is sometimes people will tell you, this company is dead, why are you buying it? I was buying it when it was actually dead. I own 46 shares. I wish I bought more. But right now, I'm actually almost broke even, and I'm still getting that dividends as well. It's a great company. The company didn't do anything. It was the market side of things. It was the cocoa prices that have gone up so much that basically the margins were getting a little bit squeezed. And for that reason, people said, oh, we're not touching this company. Will that last forever? Absolutely no. That's why it's important to know the story behind what is happening. There's a few companies that are basically down 10-15% on a day. Don't jump into the ship, basically into the first, and just buy these companies. Do your research, find out why they're down in the first place. It could be sometimes good reasons. Sometimes it's just Wall Street overreacting about simple little things, because that's what they do. So anyway, that's what I want to share with you guys today. 5 companies. Inshallah, I'll be doing a few more videos in the next couple of days. Alhamdulillah, I feel way better than I have over the last basic week or so. I don't know what it was, but it stayed with me for almost another 2 weeks after I actually recovered. But yeah, anyway, I'm gonna share more videos inshallah. If I have not responded to your comments and things like that on the Patreon, apologies. I'll be doing that in the next 24 hours inshallah. If you haven't joined us, join us, where you get access to the family portfolio and a lot of things as well. And on the Discord, basically it's free, so you can click the link on the description section and join. There's a lot of brothers who are sharing very good practices. Have a wonderful day. Assalamu Alaikum.